Thank you all so much for being here. I don't think I've ever had a standing room only crowd, so I'm touched. The camera can't show that the room is so small, but I'll take standing room any day. So yes, I figured since the book is so new, and I don't imagine anyone in this room hardly has had time to look at it, I would give you the briefest of introductions to what was for me a many-year project. And then we can move on to what will be the fun part of this for both you and me, which is the question and answer part. So without further ado, I'm going to talk to you about a segment of this study. The segment I think may be most interesting to all of you and the most germane to some of today's more pressing financial topics. So the big question that motivated the book, this really started about 10 years ago with my trying to drum up something to do my PhD thesis on, was given that by 1998, more than half of Americans were invested in the stock market, what were they doing with their money? It was known that investing had taken off as a mass activity in the 90s. Right about 1990, only about a third of Americans had investment in the stock market, and that just exploded, growing to, I believe, almost as much as 60% within 10 years. Of course, that declined pretty dramatically once again after the dot-com bubble burst in 2000, 2001. But this all happened so quickly, generally, that nobody really knew where this great bulk of people were putting their money. So I set out to try and figure that out. And since this isn't a mystery story, and I won't leave the punchline to the end, one of the things that I discovered was that people buy stocks much the same way they buy other consumer products. That identity has a huge part to play. Identity of the buyer and the perceived identity of the product or the company selling the product. So I'll tell you more about that in a second. Some of you may be wondering why you should care, especially now as the market has gone down and the proliferation of things like investment clubs, which is what I base my study on, has also decreased. I don't think the phenomenon of the individual investor has gone away, and at least in my country, I don't think it will, for a variety of reasons. Most notably the fact that we don't have the kind of social safety net protections that you enjoy here in the UK, and certainly not of the kind that are common in Central Europe, or, well, continental Europe overall. That includes job protections, it includes social security or pensions in old age, and includes national health insurance. We don't have any of that. If you get health insurance or old age insurance, it tends to be from your employer, but more and more employers are pulling back on those historical commitments. So even to employees of 30 and 40 years standing who've worked all their lives for one company, assuming that they would get a pension at the end of it, some employers, even big ones, like Fortune 500 companies, are saying, sorry folks, we can't pay your pensions after all. So it's very much an every person for him or herself society in the United States. And that's one of the main things that drives investment, is the thought that if you don't try to invest and make your own money, whether it's in the stock market or in real estate, you will probably end up living in a cardboard box on the street somewhere in your old age. And nobody wants that. So those are some social structural reasons you might care about this. A more prescient impact of this, one that reaches out to the UK and to other places, is that the sheer volume of people who are involved in this phenomenon is so vast that even if they individually don't have a lot at stake in the stock market, collectively they do have an enormous amount of power. In the US, for example, these mom and pop investors are known in the industry as retail investors as opposed to professionals or as opposed to institutional investors, which for those of you who aren't familiar with the terms, institutional investors are like pension funds or big investment funds that buy on behalf of large groups of people. Retail investors are like individuals who buy on behalf of themselves. So one measure of the impact of these folks is that at the same time as their numbers were growing, a number of things that have really changed the face of finance also arose, like socially responsible investing, which really, by the beginning of the 1990s, was still widely believed to be an oxymoron. That really you can find many quotations from well-known financial industry people saying, well, it's a nice idea, it's lovely to have morals, but you cannot make money and have a conscience. Not in the finance industry at any rate. And they have been proved wrong repeatedly. In fact, there are numerous studies I can tell you about later if you're interested, showing precisely the opposite, that companies that are perceived as being socially responsible tend to earn higher returns per share for their investors. They're more highly rated by analysts. All kinds of positive things accrue to them. So I'm not making a value statement about that, just an empirical statement that a lot of this has been driven by the individual investor who does care very much for identity reasons about the conscience and the moral impact of the firms in which they invest. For example, I don't know if this has become as visible in the UK as it has been in the US, but the Starbucks coffee shop chain has had for years now this huge campaign for fair trade coffee. And of course, you must know about BP's Beyond Petroleum rebranding of itself. A lot of that is driven by the people I'm going to talk to you about. So the overall domain of inquiry is this thing called investment clubs. Does anyone here actually know what an investment club is?
I do, because I read your book.
You do? Yeah, you published it, yes, okay. I've got my ringers in the audience. For those of you who aren't familiar with it, they're essentially do-it-yourself mutual funds that were generally composed of 10 to 15 people who would meet once a month and then pool their money to invest in the stock market. So if you were a member of an investment club, you would plunk down $30 or $50 a month, something really pretty nominal if you were a middle-class person. But then if you were together with 10 or 15 others, that would amount to something reasonable with which to pursue investments in the stock market. So this was a way of getting sort of economies of scale in terms of leveraging your collective buying power as investors. It was also supposed to be a teaching tool. The idea for investment clubs actually did not come from the United States. It came from Europe about 100 years ago, and it came over to the United States with that wave of immigration at the beginning of the last century. And until recently, it was a very marginal hobbyist movement, much like, I don't know, people who like to dress up as Darth Vader, for example. I'm sure they have conventions too, but unless I'm much mistaken, they're not very numerous. And then along comes the stock market boom in the 90s, and these groups are really poised to expand because they offer a way for people who know nothing about the stock market and its arcane terminology and maybe don't have much money, not enough money to get the attention of a traditional broker who makes his or her living on commissions. All of a sudden, these people have a way to, A, enjoy some economies of scale in terms of their financial education. They essentially have kind of a book club or a study group that meets 2 hours once a month, and they learn some of these terms. They learn from each other. And while their personal $30 or $50 might not go that far, when you combine that with that of 10 or 15 other people, that starts to become meaningful. And then after several months of taking this money that you bring together, deciding how to invest it, you own a portfolio in common. So unlike a book club, where you can be a fairly transient member, where if you don't show up or if you just decide to leave, it's not a big deal. In an investment club, they're kind of like little mutual funds in that they are regulated by the Internal Revenue Service in the United States. They're small businesses, and some of them are incorporated. But at the very minimum, because securities ownership is involved, they have to file taxes at the state and federal level. So it's not an easy thing to enter one or to leave one. It's much more like, say, a family business than anything else. The really extraordinary thing is, before the stock boom even peaked in the 1990s, 11% of the US population was involved in one of these things. Now, that's not my number. That is from a nationally representative study done by the National Association of Securities Dealers. It was a big survey that was done on all kinds of subjects, asking people what they invested in and so forth. But one of the questions on this survey happened to be, are you a member of an investment club? So if their numbers are to be believed, and this 11% is accurate, I actually figured out what the non-incarcerated US population was. Since we do incarcerate rather a large segment of our population, it was important to remove the people who are currently in prison because I don't think they're allowed to invest in securities. Still, 11% of that is 20 million people. So you begin to appreciate the magnitude of this. Those little $30 and $50 monthly contributions add up at that scale. And this was not unnoticed by politicians and by the media. All kinds of rather florid terms started to be tossed about, like the new era of shareholder democracy. In fact, when I was on your father's show last night, he played this really wonderful clip of Prime Minister Thatcher making an address, a rousing address about investor democracy and how wonderful it is for capitalism and for democracy itself, for everyone to own their little piece of the stock market. And I actually didn't realize how much George Bush II has stolen his rhetoric from Mrs. Thatcher, because he uses almost exactly the same language. To give you some scope on how far this went economically, in addition to the number of people involved, just one segment of the total number of investment clubs in the United States, those that belong to this group called the National Association of Investment Clubs, they alone controlled $125 billion in investments. Now, there's the largest institutional investor in America, and I believe in the world, is called CalPERS. It's the California Public Employees Retirement Fund. That has $143 billion in assets. So even though CalPERS operates more or less as a unit, and these investment clubs do not operate in a concerted way, at least not on purpose, they control similar amounts of economic power. Now, the reason I said that the investment clubs don't operate on purpose in a concerted way is that they are not technically under the directorship of any central authority. They're self-governing. But because they get their information from very similar sources, they end up operating as though in concert. So, for example, NAIC clubs owned over $500 million worth of General Electric, almost $500 million worth of Intel, and $1.3 billion of Aflac, which is an insurance company. That's 7% of shares outstanding, an enormous amount. So, the problem was, while it was becoming very clear by the late 90s that this investment club phenomenon was a big deal socially and economically, there was absolutely no research out there to tell me anything about it. Not just me, but anyone else who happened to be interested. And I decided that I was going to make this my domain of expertise. But I couldn't just launch into a survey, for example, because no one could tell me what to ask. So I had to start with a qualitative study. Fortunately, I was able to find 7 investment clubs in the San Francisco Bay Area, which is where I was based at the time, who were kind enough to let me observe their meetings. Fortunately, these groups, since they have an educational function, are accustomed to letting strangers sit in on 1 or 2 meetings just to see what they're about and contemplate membership, perhaps in an investment club of their own. However, I was proposing something a little different, which was I didn't want to become a member of their clubs, but I wanted to sit in and watch them discuss this rather delicate topic of money and how to spend it for a whole year. And what's more, I wanted to take notes and, in most cases, tape record. And for reasons I still don't entirely understand, they said yes. I was only turned down probably 2 times out of 10 requests. So of these 7, I had 2 all-female clubs, 2 mixed clubs, that is composed of men and women together, and 3 all-male clubs. Now, I oversampled on the all-male clubs because proportionately there are so few of them left in the US. It used to be, when the investment club phenomenon really started to take off, which was in an earlier stock market boom in the 1950s, almost all the clubs were run by men. Now, that's pretty much reversed, and more than half are run by women. So, I started with this ethnography. From that, I developed the questions that went into a national survey that went out to 3,000 investment clubs and gathered data from 43% of them, which is a pretty good hit rate for male surveys. The investment club survey had two parts. So every mailing had questions for the club president about the history of the club, but it also had a survey for all the individual members. So I was able at the same time to gather data about how long the club had been in business, what it owned in its portfolio, and about the characteristics of the members, whether they were male or female, how old they were, how much education they had, how much investment experience they had, and so forth. So then I did the standard sort of statistical regression analysis, and for those of you who are interested in methodology, I'm happy to say more about this. But let me just take you through some of the qualitative evidence, because I think that speaks most clearly to these issues of identification that I think drive a lot of these processes. One is anyone in this audience familiar with a book called One Up on Wall Street by Peter Lynch? It's a bit of an old chestnut by now. It was a bestseller back in the early 80s. Peter Lynch used to be the head of the Magellan Fund, which for a long time was known as the most successful mutual fund in history. And he wrote this book which said essentially anyone can invest. And his motto was buy what you know. That the way you can make a killing in the stock market is to invest in areas of the economy that you understand. And his example was that one of his most successful investments as manager of the Magellan Fund was in a chain of retail clothing stores called The Limited. And he found out about The Limited because his wife had been at the mall one day and came home and said, "Peter, you won't believe this wonderful store I found." So Peter pursued it, invested in it, and lo and behold, made buckets of money. So from that, a large number of the people I was studying concluded that really anyone could do it. But they behaved as if the real message was buy who you are. And what do I mean by that? Well, they had sort of implicit ideas about their social role in the world. And I don't necessarily mean status, although that was part of it. So if I went around this room and I said, who are you? You're a man in a yellow jumper. You would probably say, I'm a son. I'm perhaps a brother. You tell me about your profession. All of those things go into the answers that most people would give to who they are. Well, we know in consumer studies and marketing that people use those kinds of self-categorizations to decide what they should buy to put on their bodies or to put in their mouths. What has never been shown before, and what I certainly didn't expect to find, was that people use that for other kinds of purchases as well, such as the securities in their portfolios. So, as one example of this, I'll tell you about a club that had decided it should invest in the retail sector, discount retail to be specific. Does Costco exist in the United Kingdom?
Yeah.
Does it really? Oh, jolly good. Discount bulk shopping for all. So yes, Costco is a very successful chain of stores, much beloved in the Silicon Valley, even by some of the wealthiest people. Barnes & Noble, of course, is the bookstore, and Consolidated Stores is a kind of a holding company for a bunch of other discount retailers. So in my qualitative observations, I observed one club who had taken the vast retail sector, done a financial analysis, and had narrowed it down to 3 companies from which to choose. They could only invest in one because that's just how much money they had to spend. But they'd still done a lot of work just narrowing their choices down to 3. What was interesting was the discussion that ensued as they chose amongst the 3. They immediately eliminated Consolidated Stores. And in one of those moments where, if you're a sociologist, you practically want to weep and kiss the ground the way the Pope does when he gets off the Pope plane, one of the women in this investment club said, "Oh, we can't invest in Consolidated Stores. I can't identify with it." And then the proverbial light bulb went off over my head, and the rest of the discussion ensued, framed by that conversation, that part of the conversation. So then they went on to Barnes & Noble, and they said, well, of course, everyone likes books. Who can argue with that? But Costco, my goodness, I keep them in business. I love their biscotti. I outfit my children for the new school year from Costco. And they just sang the praises of Costco. Any executive of the firm would have been proud at that moment. But basically what they said was they could identify with Costco, or they had a personal association with a discount retailer of all things in a way they did not with Barnes & Noble. And that's why they ultimately spent their money on Costco. Not because it was clear that Costco was going to make them more money. It was sort of a horse race between Barnes & Noble and Costco, as it is for professionals, by the way. If you look at the very few studies that have been done of finance professionals, they often talk about these instances where it's not clear financially or on purely financial grounds which of a basket of investments is really the best or the most promising. Often, there are so many investments to choose from that you can narrow it down to a handful that all look fairly promising, but then you have to make a judgment call amongst them. So what's really interesting is, how do people make those judgment calls? Turns out a lot of it has to do with who they think they are. Another one of those kiss the ground moments was when I observed the very, very dignified woman who's the president of her mixed gender investment club, a woman who was herself an accountant. I asked her about the club's previous portfolio purchases before I arrived on the scene to observe them. And so she took me through all of the club's investments since the inception of the group. And she started by saying, oh, RPM, that was our first purchase. That was our boy stock. And I kind of did a Scooby-Doo and went, "Rawr?" Excuse me, did you just say boy stock? And without missing a beat, she continued and said, well, this is our second stock purchase. Here's St. John Knits. That was our girl stock. Without apparently realizing what an extraordinary thing that was to say. So I pushed her a little bit and said, well, how, in what way are RPM and St. John Knits boy stock and girl stock, respectively? And she said, oh, RPM, they make boring things like glue and ink. And all the men in the club wanted to buy it. But St. John Knits, do any of you here know what St. John Knits is? No one with an X, all the double X chromosomes are going, yep, we know. They are a high-end manufacturer of women's suits, among other things. And so by high-end, we're talking about $3,000 to $5,000 US for a suit. Little knit suits that you wear to luncheon at the club. So that's the girl stock. What was even more extraordinary was going through the rest of the club's portfolio, and she could categorize boy stock, girl stock, boy stock, girl stock, every single one. And I came to realize that while other people I had been observing did not use those terms, they essentially saw the stock market mapped out in the same way, that there was a kind of what I called a logic of gender appropriateness, not unlike what you see among small children in nursery school or kindergarten. Famously, you can still ask people, even in the 21st century, little 5-year-olds, what do you want to be when you grow up? And sometimes if you ask in a mixed gender setting and a little girl says, I want to be a doctor, sometimes the girl or the boy next to her will say, well, no, you have to be a nurse. That's what girls are. Or the boy says, I want to design shoes, and the girl says, no, you can't do that. That's my job. It's a little troubling to see among young people, but it's eye-popping to see among mature people in their 50s who are professionals and who, if you pin them down on the subject, would say, well, I don't have those stereotypes. I mean, look at me. And yet, faced with the vast uncertainty that is the stock market, as in many things, people tend to regress. And this is one of the particular ways in which people regress to what they know, their comfort zone, if you will. So the other part of deciding to buy a stock, in addition to the gender screen, was social responsibility. And I'm convinced that this is one of the things that has driven the larger phenomenon of socially responsible mutual funds growing at like 3 times the rate of all other forms of investing. One of the people I interviewed talked about a decision about Harley Davidson. This is what I talked about on your father's show last night, or he asked me about this. And there was also a different group a very successful group of investors, all women, who had looked at the leisure sector of the economy. So they'd narrowed down, again, hundreds of opportunities to just a few: Harley-Davidson motorcycles and the Harrah's Gaming Consortium. And they were narrowing down pretty clearly on Harley-Davidson, and it looked like it was going to be a unanimous vote in favor, until one woman raised her hand and said, "But really, would you want your husbands and your sons and your brothers riding one of these things?" And you could just see the big smiles disappear from everybody's face. And they sort of hung their heads, and they couldn't say, "Yes, I'd be fine with husband, brother, son riding a Harley-Davidson." And so they decided ultimately not to invest in the company, even though it looked like it was going to make somebody a big pile of money. And afterwards, I talked to some of the people who had been initially most enthusiastic about the firm, and I said, what happened? Why did you end up voting against the firm you had so strongly supported? And they said, well, it's just not the kind of people we are. And so this is one of those moments in sociology where people say things that are very revealing, at least to a sociologist, without seeming to realize how, telling those remarks really are. So I found similar instances in the course of a year, over and over again, with investors who might not even necessarily have called themselves socially responsible, but often in the choice amongst a few firms, they would end up at points where they had to decide, is this the kind of person I am? Is this the kind of person I want to be? I suppose on the assumption that eventually they would be in some cocktail party conversation and someone would say, so, what have you been buying in the stock market recently? And I don't know if this was true in the UK, but in the US there was just this odious period in the late 1990s where you could not go anywhere without having someone talk to you about the stock market and ask you what was in your portfolio. It was a remarkably personal question that no one seemed to have any compunction about asking. On the contrary, people seemed to be proud to say, well, I own this and that and that. But in order to interact that way successfully, you better not own the so-called sin stocks, because then you were likely to get a very negative reaction from people. Oh, I've made a killing in tobacco. That wouldn't go over very well at all.
Brooke, can I give you a kind of 2-minute
yes,
warning?
I believe I'm at
Otherwise
the
we won't
last
have
slide.
Yeah.
So the driving process here is sort of a need for some sort of cognitive coherence. You've probably all heard the term cognitive dissonance from social psychology. Cognitive dissonance simply means that people avoid situations that dramatically clash with their idea of who they are. Well, in the process of doing that, you can make choices that reinforce or elevate your sense of who you are. And it's not surprising to find people doing that with all sorts of consumer goods. It is rather remarkable to find them doing it with the purchase of items that are supposed to have purely instrumental, profit-oriented meaning to people. So here's my last slide. This is sort of a different answer to the so what question. Some of you may be familiar with a book that was written about a century ago by Thorstein Veblen, The Theory of the Leisure Class. That's where he coined the well-known term conspicuous consumption. He was describing America during the Gilded Age, back before we had an income tax, when the Rockefellers and the Vanderbilts and so forth could amass enormous fortunes. And they not only did that, but they made sure everybody knew it. One of the other things that he said was that there are roles in this pantomime of wealth, and that the roles divide along gender lines. It is the duty in the Gilded Age, he said, of the wife of a well-to-do man to flaunt her husband's wealth. The man makes the money, the woman displays the money. And so thus we got these enormous ostrich feather hats. And, well, you know the role of, say, the Vanderbilt women in designing what they called the cottages of Newport, Rhode Island, these vast places made of gold plate and marble. It was their job to design and decorate for the benefit of their husband's social status. So men as producers, women as consumers. Believe it or not, when I actually did a quantitative analysis of the contents of investment clubs' portfolios, what I found was that the more women that were in any given club, the more that that club invested in the consumer products sector of the economy, which has to do with what people think they know about the economy. The vast majority of the women in these clubs I surveyed were professionals. That is, they worked outside their homes. They had as much basis as all of the men in those clubs did to use their work experience or their professional training as a basis for investment decisions. And I regularly saw the men do that. So the doctors got their clubs to buy pharmaceutical stocks. The bus drivers got their clubs to buy oil company stocks and so forth. But the women, no matter what they did professionally, not exactly were forced into talking about the consumer products sector as their area of expertise, but they seemed to self-select into that. And I believe that has something to do with just the newness of this investment process for everyone involved. We tend to revert to our comfort zones. And at least in America, most professional women who work outside their homes also are the primary caregivers inside their homes, and they do most of the shopping and the housekeeping. So it is indeed something they would probably know more about than the men in their lives. Still surprising to see in their investment behavior. So empirically, I would predict this would lead to more of these so-called identity funds. You may know there are special investment funds for people of different religious backgrounds. There are ones that are, say, for Lutherans. One of the most successful ones in America is a Lutheran investment fund, and I'm still not quite clear how that's different from like the Baptist investment fund, but please don't strike me down for being an infidel. There are Catholic investment funds. They don't invest in, say, healthcare and hospital chains that perform abortions. There are Muslim investment funds that are compliant with Sharia law. There are animal protection investment funds. There, it could go on and on. I think there are going to be more. Finally, and this is the real implication for Wall Street and the financial industry, knowing that this vast bolus of people moving through the economy with money to spend are scrutinizing the identities of the corporations whose securities they buy, not just as a financial opportunity, but as an opportunity to say something about who they, as the investor, are. I think firms are going to have to start managing that identity to the retail investor and not just to the analysts and the Wall Street crowd on whom they've been focusing up until now. So I'm sure you all have some questions about what this means for today's credit crunch and so forth. I'll open the floor to you.
Brooke, thank you very much. Okay, that was brilliant. I think a couple of people have got to go and other people might want to sit down. So do you want to shuffle around a bit if you're, if you haven't got a seat, grab a seat. Okay, great. Well, that was absolutely fantastic. And I've got 2 or 3 questions before we open up. The first one is, and this is, I have to admit, my father put me onto this, is that a lot of people know about the social capital literature and Robert Putnam's work, yes, which is kind of pessimistic about people's willingness to come together in networks which look rather like this. So Putnam says that people don't really want to go out together, they don't want to meet strangers, it's all stuff they do with their families. But from my recollection of reading social capital and other social capital theorists, they've never talked about this phenomenon. So do you think there's a kind of snobbishness which says, we're not going to treat this as proper social capital because these people are trying to make money? And have you had any kind of response from social capital theorists about this?
Yeah, I've actually published an article a couple of years ago. Those of you who are real gluttons for punishment and can wade through academic prose, on my website there is an article called Tiny Publics, which is precisely a rebuttal to Putnam using some of this data. As one of my colleagues at the Max Planck Institute, the Santa Fe Institute once said, in social science it's really not that important to be right. You're probably going to be wrong, but you try to be wrong in an interesting way. And so I think Putnam was wrong, but he was wrong in an interesting enough way that he inspired a lot of people to argue with him, not just me. One of the little discussed aspects of Bowling Alone, his study which claimed that associational and civic life in America was going to the dogs, was that he used as his measure of association these rather moldy fraternal organizations like the Elks and the Lions clubs, stuff that my grandfathers belonged to, but are
There's
no...
nothing wrong with long established organizations.
Not at all. Not at all. In fact, I have to say the Elks treated my grandfather very well, and I believe they've started to accept women. Now, there goes the neighborhood. But what Putnam didn't seem to consider is that associationalism can take different forms over time, and I think it's quite clear if you look at history. For example, in late 19th century America, the great rage was for women's temperance associations. So if we observe that there aren't any more women's temperance associations, should we throw up our hands and say, oh no, no more associational life in America? Well, no. Putnam, I think, was looking at the forms of association that were prevalent during his generational experience. Karl Mannheim, the great German sociologist, said we all have this problem of generations, that we are marked by a certain set of experiences that are dominant when we're growing up, and sometimes we forget that things change. It sounds awfully simplistic, but I was astonished when I really looked into the bases for Putnam's thesis, and as you point out, investment clubs are just one of the many new forms of associational life that exist in the US and in the world. Putnam didn't seem to take the internet into account at all as a basis for associational life, and that seems like an obvious place that people have found ways to associate, congregate, not just virtually, but face-to-face as well.
You know, this is, I think, fascinating to us because one of the areas that we are interested in, we've titled rather sort of clumsily New Collectivism, which is to say that we don't think that people have lost their desire to do stuff with other people, but what they don't want is the old kind of hierarchical, bureaucratic, sort of self-denying ways of doing stuff. What they want now is kind of egalitarian, diverse, self-actualizing ways of coming together, and your book seems to kind of speak to that idea. So Putnam, he's misunderstanding what's going on here. We're not actually losing our desire to do stuff.
No, on the contrary.
Oh, okay, brilliant. The next question I want to ask, which is one you kind of alluded to at the end, which is, you know, what happened? These clubs, presumably all the time you were observing them, they were kind of doing well. You know, every week or every month they'd meet and see how much money they've made. Now, presumably they're working in a pretty different environment now.
Right.
Now, what do you know what happens, or what do you think will be happening as they meet and they're discussing their losses rather than meeting and discussing their gains?
Well, believe it or not, it was possible to lose money during the 1990s, and interestingly enough, this goes back to your point about how people really seek out opportunities to be with each other. And one of the clubs I saw that lost money most spectacularly, and I think most needlessly, was a group of retired insurance industry executives who met every month at their golf club after a round of golf. Now, I mentioned their previous professional experience because they were in no sense naive about investment and finance. They were miles ahead of many of the other clubs that I studied. However, they would do some really counterproductive things for the market of the late 1990s. For example, they put stop-loss orders on most of the stocks in their portfolio, and that automated the process of selling a stock if it went below a certain per-share value. Well, since the clubs only met once a month, and the market at that time could be extremely volatile, it was not uncommon for any given stock that they owned to take a one-day plunge or a 1 hour plunge and then bounce back up either the next day or in the course of the same day. It was quite commonplace, actually. So they kept getting sold out of very valuable stocks in their portfolio needlessly, and then having to buy them back again at a premium with commissions on both sides of that transaction, if you please. And I once went to the trouble of adding up for them exactly how much it was costing them to keep the stop-loss order program in place. It happened to them with Cisco Systems, which at the time was a very, very hot stock, and it literally would lose 100 points in value during a day and then regain 150. So over time, it could have made them a lot of money, but they kept selling it and buying it, selling it and buying it, selling it and buying it. And I actually presented them with the data at one point, about 6 months into this, because I just couldn't stand it anymore. I couldn't stand to watch them lose money. And I said, gentlemen, this is how much you've lost in the last 6 months on Cisco alone. Do you think maybe it's time to reconsider the stop loss policy? And they said, oh, no, it works great for us. And they just weren't having it. The powers of denial are rather strong. And when I went back to interview all the clubs I'd studied in the late 1990s, in 2004, after the stock market bubble had really burst, and I expected to find no one still investing, 4 of those 7 clubs were still in business. Now, of course, they'd lost a lot compared to where they were in 1998 and 99. But I finally worked up the courage to ask this group of retired insurance executives, look, you guys put in $50 a month. You've more or less lost money compared to what you could have earned on a passbook savings account had you just sort of put the money into the local Bank of America. Why are you doing this? If you want to spend $50 a month, go out to the local pub, have a drink together. And they said, yes, but then our wives would be angry because we weren't bringing them along. This is the only legitimate way we can get together. I swear to God, I could not make this up. I was trying to retain my professional composure, so fist firmly under jaw to prevent it from dropping. But this was their rationale. It was the only way they could have a boys' afternoon out without upsetting their wives, and they were willing to go through this charade of investing for the privilege of that. And that's exactly what it was. So really, it was investment, a sort of socially fashionable activity, being used to drive the real motive of those get-togethers, which was social.
We're about to embark on a project here called Tomorrow's Investor. We did a project a few years ago called Tomorrow's Company, which spawned an NGO working in that field. But Tomorrow's Investor is going to be working with people who've got investments through institutional investors. So they're not people involved in clubs like this, they're not entrepreneurs themselves, they have investment indirectly, as it were. And the idea is to explain to them how their investment works, to explain to them how bad some of the decisions made on their behalf can be, and to explain some of the ethical dimensions. And what we're interested in exploring is, when investors understand all this stuff, do they want to get more active? Or maybe they just shrug their shoulders and say, well, life's too short. What's your kind of hunch about that great mass of people who aren't involved in investment clubs, but who have investment managed by other people at arm's length? Do you kind of feel that there's a great untapped capacity amongst those people? Were they to be empowered? Were they to know more? Were they to feel that they could use the same kinds of motivations as people in your investment clubs are using to manage their own stuff? Do you think that they would want to be more active in that?
I have to say I'm slightly biased in answering this question, because I did read the part of your website on Tomorrow's Investor, and I saw the survey results that said, on the one hand, many of those surveyed said, oh yes, absolutely, investors should be more active in holding their investment firms accountable. And then the brilliant follow-up question was, well, how about you? And it was like, oh, no, don't have time, or what have you. I suspect that many Americans would feel similarly about this, which is they're so pressed for time that the idea of taking on one more task, especially of sort of accountability management, is simply overwhelming.
Right. I wonder if someone pointed out to me that when the Vodafone's misconceived purchase of Bertelsmann, I think, cost the average middle-class family £5,000. It's so bad was it as an investment decision. Perhaps if people knew kind of stuff like that, they might get more active. Now, can I ask you just finally, before I bring in the audience, you're very modest in presenting your findings, because you missed out quite a lot of really rich stuff that's in the book by the book folks. And one of the things you didn't, I don't think, refer to was the fact that diversity seems to be a good thing.
Yes.
That mixed gender groups and mixed ethnic groups seem to do kind of better than your golf-playing, white, middle-aged insurance people. So just want to comment, we had Scott Page speaking here last year, who talks about the value of diversity in the workplace. So how do you think your work, does it just tell us about the value of diversity in the particular context of investment clubs, or would you claim that there is a broader set of insights you're getting here about the relevance of diversity in wealth creation and collaboration?
I think the latter. Ironically enough, Scott Page and I have sort of been following each other around on the lecture circuit for almost 5 years now. We first met at a Credit Suisse First Boston seminar called the Thought Leaders Forum, where he was talking about diversity and I was talking about diversity, some of the early results from this very study. And as you've mentioned, one of the things that I found is that investment clubs made up, say, of men and women together make more money than male-only or female-only groups, to the tune of about 2% excess returns on investment. Now, 2% may not seem like very much, but a good analogy would be if somebody offered you the chance to buy a bond, and one returned 3% compounding and the other returned 5% compounding, everyone in the room, I think, would take the 5% bond. Not just because of the 2% interest rate difference, but because compounding daily or monthly or even yearly, the money grows faster. So that 2% annual return on investment difference for diverse investment clubs, or at least gender diverse ones, adds up to quite a great deal of money over time. And what's particularly satisfying and unexpected about that is that it doesn't fall into many of the expected routes of saying, well, women are better investors, nerny, 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 or men are better investors, get back in the kitchen. It says that there is something beneficial to having a variety of opinions to bring to bear on a decision-making process. That actually is not my insight. That's a very old insight from social psychology. What hasn't been done before is to show the dollar value of that, or the financial value of it. Previously, studies of diverse groups have shown that while they take a longer period to ramp up, because these people of different backgrounds are taking time to get to know each other and figure out how to work together, it is also the case that if you give them enough time, and enough can mean a couple more hours or a couple more weeks, they produce better quality decisions. Now, in the past, the problem has been that better quality has been measured by things like creativity or self-reported satisfaction with the outcome, stuff that's hard to present to a group of financial industry people and have them not laugh you out of the room. The reason that what I found with investment clubs is generalizable is because you can, and I have taken it to a number of people in the finance industry and said, look, diverse investment teams can make you more money, bottom line. And miraculously, some of them say, you know, I've seen instances like this. I know what you're talking about. Most hiring processes in most companies, not just finance, is geared to making people hit the ground running. So that tends to reinforce homogeneity. You want people who are not going to need that time to ramp up, or people who are not going to make their colleagues spend time figuring out how to work with them. But long run, and long run thinking is a luxury that many people in the finance industry unfortunately do not have, long run, they contribute enormously to the decision-making process in two ways. The obvious way is that they may have a different perspective on the problem to be solved. And it turns out, in the case of investing, men and women, even if they've been trained in similar ways, say economics degrees from the same school, still tend to have different perceptions of the economy and have views about how to evaluate a company that are different from one another. And that has to do with earlier aspects of their life experience and gender socialization. So they're different, they're probably going to stay different no matter how much professional socialization they get, and that's a good thing. Not only that, but there's some really interesting evidence from finance that people of different ethnic and religious backgrounds, and certainly of different age backgrounds, have very different perceptions of the economy and of risk, of what constitutes an appropriate investment. And here's where Scott's work and mine overlap. We were both fellows at the Santa Fe Institute, which is devoted to topics in complexity. The market is a complex system. Decision-making in any complex system benefits from having more resources to bring to bear on the decision-making problem. So the more information you have, the better. However, just assembling a group of people with different ideas doesn't mean that they will share those ideas with one another. There are all kinds of conformity pressures that exist in groups that tend to preclude the sharing of uniquely held information. So the group dynamics issue is one in which this is where leadership often comes into play. If you can set the example as a leader in your organization that it's okay to have differences of opinion, you're much more likely to draw out of people the diversity of ideas that they actually have to contribute, and the whole organization will benefit from that.